Hey everyone, and welcome back to the channel. Today, we're diving into a topic that's on every entrepreneur's mind: how to get funding for your business in the USA, whether you're just starting out or looking to expand. Getting the right capital can feel like a huge challenge. But don't worry, I'm here to break it down for you. We'll be focusing on two of the most popular and accessible options: SBA loans and business lines of credit. By the end of this video, you'll have a clear roadmap to navigate the world of business financing. So, let's start with the big one: SBA loans. What exactly are they? The Small Business Administration, or SBA, doesn't actually lend money directly. Instead, it partners with lenders like banks and credit unions and guarantees a portion of the loan. This guarantee reduces the risk for the lender, which makes them more willing to approve loans for small businesses, often with better terms and lower interest rates than you might get otherwise. Think of the SBA as a powerful co-signer for your business loan. This makes them a fantastic option, especially for new businesses or those that might not meet the strict criteria of a conventional bank loan. There are several different types of SBA loan programs, but the most common one is the 7A loan program. This is the SBA's flagship program, and it's incredibly versatile. Another popular option is the SBA 504 loan program. This one is more specific. It's designed to provide long-term fixed-rate financing for major fixed assets that promote business growth and job creation. This means it's perfect for purchasing land, buying or constructing buildings, or acquiring heavy machinery and equipment. The structure is a bit different. Typically, a bank or conventional lender provides 50% of the project cost. The SBA provides up to 40% through a certified development company, and you, the business owner, contributes the remaining 10%. The key benefit here is the long-term fixed interest rate on the SBA's portion, which provides stability and predictability for your finances. So, how do you actually qualify for an SBA loan? While the SBA guarantee makes it easier, you still need to have your ducks in a row. Lenders will look at several key factors. First, your personal and business credit scores. A strong credit history is crucial. Generally, you'll want a personal credit score of at least 680, but the higher, the better. Lenders want to see that you have a track record of responsibly managing debt. Next up is your business plan. This is your chance to tell your story and show lenders that you have a solid, viable business idea. Your business plan should include detailed financial projections, a market analysis, information about your management team, and a clear explanation of how you'll use the loan proceeds. It needs to be professional, thorough, and realistic. Don't just throw some numbers on a page. Show your work and justify your assumptions. Then there's your business's financial health. Lenders will want to see your financial statements, like profit and loss statements, balance sheets, and cash flow statements. If you're an existing business, they'll typically want to see at least 2 years of financial history. For startups, your financial projections in the business plan become even more important. You need to demonstrate that your business can generate enough cash flow to comfortably cover the loan payments. Finally, you'll likely need to provide some form of collateral. Collateral is an asset, like real estate or equipment, that you pledge to the lender to secure the loan. If you default on the loan, the lender can seize the collateral to recoup their losses. While some SBA loans might not require specific collateral if the business assets are sufficient, having it can definitely strengthen your application and be prepared for a personal guarantee. This is a promise that you, the owner, will personally repay the loan if the business is unable to. It's a standard requirement for most small business loans. Now, let's shift gears and talk about business lines of credit. This is another fantastic funding tool, but it works very differently from a traditional loan. Think of a business line of credit like a credit card for your business. Instead of receiving a lump sum of cash, you're approved for a certain credit limit, let's say $50,000. You can draw funds from this line as you need them up to your limit. You only pay interest on the amount you've actually used, not the total credit line. Once you repay what you've borrowed, that amount becomes available for you to use again. This flexibility is the biggest advantage of a business line of credit. It's perfect for managing cash flow fluctuations, handling unexpected expenses, or seizing opportunities that require quick access to capital. For example, maybe you need to purchase inventory to meet a large unexpected order, or maybe you need to cover payroll while you wait for a client's payment to come through. A line of credit is an ideal solution for these short-term needs. You don't have to apply for a new loan every time you need cash. The funds are there, ready and waiting for you. There are two main types of business lines of credit: secured and unsecured. An unsecured business line of credit is not backed by any specific collateral. Because of this, it represents a higher risk for the lender, so they are typically harder to qualify for. You'll usually need a very strong credit score, a solid business history, and robust annual revenue. The credit limits for unsecured lines are also often lower. A secured business line of credit, on the other hand, is backed by collateral. This could be accounts receivable, inventory, or other business assets. Because the lender has collateral to fall back on, secured lines are generally easier to obtain, and they often come with higher credit limits and more favorable interest rates. For many small businesses, especially newer ones, a secured line of credit is the more accessible option. So, which one is right for you? An SBA loan or a business line of credit? The answer really depends on your specific needs. If you have a large one-time expense, like buying a building or a major piece of equipment, an SBA term loan is probably the best fit. You get a large sum of cash upfront and a predictable repayment schedule over a long period. But if your need is for ongoing working capital, managing unpredictable cash flow, or having a safety net for unexpected expenses, a business line of credit is likely the better choice. Its revolving nature gives you incredible flexibility to manage your day-to-day financial needs without taking on a large fixed debt. In fact, many businesses have both. They might use an SBA loan for their long-term growth investments and a line of credit to manage their short-term operational needs. The two can work together beautifully as part of a comprehensive financing strategy. Alright, so to wrap it all up, let's quickly review the key steps to getting funded. First, get your house in order. That means building a strong personal and business credit score, preparing detailed financial statements, and crafting a killer business plan. Know your numbers inside and out. Second, determine your specific funding needs. Are you looking for a large lump sum for a big project, or do you need flexible access to cash for ongoing operations? This will help you decide between a term loan, like an SBA loan, and a revolving line of credit. Third, research your options. Don't just go to the first bank you see. Compare different lenders. Look at their specific requirements, interest rates, and fees. SBA preferred lenders can often streamline the SBA loan process. Online lenders can be a great option for lines of credit, often with faster application and funding times. Applying for business funding can seem daunting, but it's a process. By being prepared, understanding your options, and presenting your business in the best possible light, you significantly increase your chances of success. It's all about demonstrating to lenders that you are a good investment. I hope this breakdown was helpful for you. Getting the right funding is a critical step in building and growing a successful business. If you found this video useful, please give it a thumbs up and don't forget to subscribe for more content to help you on your entrepreneurial journey. If you have any questions, drop them in the comments below. I'll do my best to answer them. Thanks for watching, and I'll see you in the next video.